Welcome back to Factful Finance, the place where we make money management less intimidating and more exciting. Here's a question for you. What if there was a way to protect your investment from one of the most frustrating financial forces out there, inflation? Well, there is. Let's dive into inflation-protected bonds and see how they could help safeguard your money. Before we dive in, a quick disclaimer. This is for educational purposes only. Always consult a financial advisor for advice tailored to your specific situation. All right, inflation-protected bonds, also known as Treasury Inflation-Protected Securities or TIPS, are a type of bond issued by the U.S. government. They are designed to protect you from inflation. Sounds like a dream, right? But how do they actually work? First, let's break it down. Inflation erodes the purchasing power of your money over time. So if you're saving for the future, it's important to keep that in mind. But here's where TIPS come in. When you buy a TIPS bond, the principal value is adjusted based on the inflation rate. This means if inflation goes up, so does the value of your bond. Your interest payments, calculated as a fixed percentage of the adjusted principal, also increase. That means you're not just earning interest on the original amount you invested, but on the inflation-adjusted value. Let's put that into a real-world example. Imagine you're Liam, and you purchase $10,000 worth of TIPS at a 2% interest rate. If inflation rises by 3% over the next year, your bond's principal increases to $10,300. That 2% interest will now be calculated on the new principal, giving you $206 in interest instead of just $200. So not only are you protecting your investment from inflation, but you're earning more because of it. Pretty powerful stuff, right? Now, it's important to note that TIPS are not risk-free. If inflation is low or negative, the returns on these bonds might not be as high as other investments. Plus, the government does guarantee the principal, but there's still the risk that you might not keep pace with other investment opportunities, like stocks, over the long term. That's why, just like with any investment, it's essential to assess your goals and risk tolerance. Another thing to keep in mind is that TIPS are typically issued with maturities of 5, 10, or 30 years. So they can be a great option if you're looking for a longer-term investment that can ride out inflation cycles. However, if you need liquidity or plan to access the money sooner, TIPS might not be the best fit. Let's take a look at how they perform in different scenarios. For example, during periods of high inflation, like the early 1980s, TIPS can really shine. In contrast, if inflation remains low or the economy enters a deflationary period, the benefits of TIPS may be less pronounced, and other investments might outperform. In today's world, with inflation concerns looming, many investors are looking at TIPS as a way to hedge against rising prices. But like any financial tool, they work best when used as part of a diversified portfolio. Experts recommend balancing TIPS with other assets to help spread risk and potentially boost returns over the long term. So, if you're wondering how to incorporate inflation-protected bonds into your strategy, think about it as a way to add stability to your investments, particularly if you're concerned about rising costs in the future. TIPS aren't for everyone, but they are a powerful tool for those looking to protect their purchasing power in an unpredictable economy. Before we wrap up, what do you think? Are TIPS something you would consider for your portfolio? Maybe you already own some? Let us know your thoughts in the comments below. Thanks for joining us here at Factful Finance. If you like what we're doing, why not subscribe so you don't miss out on future videos that will help you secure your financial future? And while you're at it, click that bell to be the first to know when new videos drop. We think you'll find the next video on your screen helpful for your financial goals. See you next time.